Hello and welcome to the Stansberry Investor Hour. I'm Dan Ferris. I'm the editor of Extreme Value and the Ferris Report, both published by Stansberry Research.
And I'm Corey McLaughlin, editor of the Stansberry Daily Digest. Today we'll talk with our colleague, Brett Eversole, editor of True Wealth.
And Corey and I will talk about Dr. Doom. Dr. Doom is bullish. It's incredible.
And remember, if you want to ask us a question or tell us what's on your mind, email us at feedback@investorhour.com.
That and more right now on the Stansberry Investor Hour. Well, I guess we should tell the folks who Dr. Doom is before we do anything else.
Yeah, that would probably help, right?
Yeah. So Dr. Doom is Nouriel Roubini. He's an economist who had his 15 minutes of fame, which kind of stuck. He got famous for doing one thing right, and I don't know if he's done anything right since. And that was an extremely bearish outlook before the 2008 global financial crisis happened. He was one of the louder voices saying, oh my God, it's going to be terrible, et cetera, et cetera. And I can't name, I won't say I've kept up with him meticulously, but I can't find any major other big call that he made that worked out really super well. But that's who he is. He's
I
Dr.
do remember,
Doom.
actually, to give him credit on that point, I do remember ahead of 2020 and the pandemic and the shutdowns and the stimulus checks, he actually said that the next time we have this crisis, you'll see the government sending money directly to people. And so I think that was a pretty good one. I believe he might have said that at our he's talked at our Stansberry conference.
Yeah.
In maybe 2018 or 19 when he said that. So
yeah, I think he did. I forgot about that. You're right. Yeah.
Yeah.
Very good. I'm glad you remembered that. That's who he is, and that's what he did. And now, just recently in the past few days here, a Bloomberg article came out and said, and I quote, Nouriel Roubini, the economist known for his bearish outlook ahead of the 2008 global financial crisis, expressed optimism that the U.S. growth will remain brisk this year, though that might be a negative for stocks. And then he also said he sees diminishing chances of a so-called soft landing where growth and inflation cool without a downturn. And he's actually talked recently about no landing, meaning, no recession, no problem of any kind. So overall, it's a fairly bullish picture from a guy named Dr. Doom. And I sent you a link to either this article or maybe it was another one. And I said, I titled the email, "The Last Bear is Gored," right? Because that's what happens in raging bull markets. There's always one last guy who's known as a bear and who says, well, I think the market's just going to keep going up. I think everything's going to be okay. We're not going to have a recession, et cetera, et cetera. And I don't know if this really is a last bear is gored moment, but it's got that feel to it. And I know that stocks are at mega bubble valuations, and that there could be some nasty stuff brewing in the banking system. We're in an election year. There's uncertainty. So it has that feel to me.
Yeah. And in response to you saying last bear gored, I think I said maybe it's time to take some profits.
Yes, you did.
When you see something like that happen.
Yeah.
I mean, it's if nothing else, it is a sign of how far we've come since in the last year or so. When everybody was expecting when quote everybody was expecting recession and it didn't show up. Technically speaking, I mean, there's been problems, whether you call it a recession or not, but whatever. I mean, there actually was a technical recession in the early 2022, the first 2 quarters. So
you
could argue it already happened and then the market bottomed, which would be consistent with past history before the last 2 years. But yeah, it just shows you how far we've come. And I mean, you can't argue with what the market's doing. I mean, last week you got more new highs in the U.S. and in Europe. Europe and the U.S., all the central banks are talking about cutting rates around the same time in the summer now, and it looks like it's kind of they're coordinated to say inflation's not a problem anymore, and away we go. And that's what it looks like now. You're also getting like the inflation protection kind of trades back in with gold recently moving higher, and you could
New all-time
argue
highs. Yeah.
new all-time highs for gold finally above 2000, which gold bulls have been waiting for it's been pushed up there about 4 different times in the last couple of years. So this actually looks like it might be pushing higher than that, for good, maybe. You can make an argument that part of this Bitcoin rally has some inflation hedge argument to it. I don't think that's the whole thing, but it might be part of it. And so, yeah, it's we're in the cutting rate period, anticipation period, of this whole cycle now. So
Right.
looks like,
Yeah, it sure
yeah,
does. That's right. That explains the move in gold pretty well too. Doesn't explain why nobody still really wants gold stocks very much. I mean, they've given a little
right.
pop
The
back
gold
up
miners are
here,
still hurting.
but
Yeah,
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 yeah, it's just they're still kind of unwanted, and the industry seems to have learned something over the past 3 decades of they produce negative free cash flow for through I think it was like 2022 or so. Um, just doing a horrible job at financially, and they got some discipline and they're fixing their problems. So as businesses, mining isn't great. I'll say that all day long. It's terrible business, but they're doing a lot better than they were, and still can't catch a break, can't get a bid. So they're pretty attractive, even though gold is hitting new all-time highs. It's actually closer to, as we speak, it's closer to 2,200 than 2,100 at around 2,156. So that's really cool.
yeah.
And silver's
Next
perked up a
stop,
little bit.
3,000 or
Yeah,
10,000, or what?
yeah.
What do we got here?
There you go. Yeah, you know. Okay, so Corey has just called the near-term top in gold, so we don't.
All right. Yeah, there we
Yeah,
go.
that's right.
If it was Bitcoin, it would move $1,000 a day or in an
That's right.
hour, but it's not. So,
Yeah.
all right.
Yeah. Speaking of which, it is making, it is ramping up towards a new all-time high, or has it hit one already? It's at 67,800 as we speak. And I forget what the exact number was back there at the
Bitcoin, yeah,
top.
it briefly went over 69,000 last
Okay.
week, briefly, and
All
then
right.
promptly dropped 10%, right off of that. And so,
Okay.
um, I guess you could say it made a new all-time high, but it definitely has not stuck that landing up there. So,
Okay.
um, yeah,
But given its
volatile, a
volatility,
lot of
yeah.
yeah, volatile, I think I sense more interest in it again. I feel like it's
Hmm.
this whole cycle with Bitcoin and cryptos is really still early yet. I mean, you're getting it into the mainstream financial
Yeah.
media again, with these new, like, getting close to new highs. But um, as far as like individual people, I haven't been hearing a ton from, you know, people who I heard from like 2 or 3 years ago when Bitcoin was making new highs. Like, hey, what's going on with this? Haven't heard that yet. So that's any indication that story might still have a lot of room there. So, but yeah, it's going to be volatile no matter what happens.
But I was going to say, considering its um, extreme volatility, being up above 67 after hitting 69, like as far as I'm concerned, it's still just pushing up against new highs. So it's
Yeah,
performing
yeah,
really well, actually. Um,
yeah. Rebounded since that 10% drop. I should have said, yeah,
yeah,
to your point.
and
So yeah,
and it's been, I mean, it's pretty breathtaking. It was in the mid-teens in late 2022, and now like spitting distance of 70. You know, that's that's pretty breathtaking stuff there. I
Yeah.
really regret not getting back in. I have to say, I should have known. You did
Well,
though,
it might
didn't
not
you?
be. It might not be over yet.
Yeah,
It's. I don't think it is. Yeah, I did. I mean, I
good for you.
remember it was a little early on my new Bitcoin highs
Hmm.
prediction from 2 years ago when the
Right.
sentiment was awful. A year late, but
Yeah.
the same argument was there. Yeah, it went from so hated to back higher and just so quickly um with the ETFs being greenlit by the SEC.
Hmm.
It's just kind of this. I mean, okay, it's definitely not what like Satoshi Nakamoto or whoever wrote that white paper had in mind
No,
way back when.
no,
What's
we're
going
still in
on now?
speculative territory here. Yeah,
Yeah.
Absolutely.
Like the ETFs, which then these institutions, which then are buying Bitcoin, and like that's its own kind of cycle happening now, that's pushing the price up. Um, and does that feed on that feeds on itself? It's just it's a
Yeah,
little. Uh, it's definitely got that speculative
oh yeah,
flavor still heavy on it, but
yep,
yeah, the moves have been pretty amazing.
yeah. I mean, I'm fond of saying that if it ever does fulfill that dream and become a stable, currency, store of value, whatever you want to call it, it'll be at like $1 million. And then that's when I'll say, okay, it works. Now I'll buy. And that's how you'll
Yeah.
know that the big money has all been made, and there's very little left to make in Bitcoin. When Dan finally says, "Oh, this works," I think I'll buy it now for $1 million. After missing it at at 16 or 17, after getting another bite at the apple, having bought it at
Well,
10. Yeah,
if you can buy it when it's a million, then more power to you. That's
yeah, that's right.
you'll be good. Yeah, no
Yeah.
matter what you do.
All right,
It is
so
interesting like just quickly on like Ethereum, like the Ethereum and the other cryptos. I still think that's where the utility part gets overlooked. Like some of
mhm,
these smaller coins that are attached to actual real projects where there's some value attached to the different coins depending on what they're
mhm,
used for. And like our
right.
Eric Wade knows all about that and crypto capital and whatnot,
Yeah, it
far
has
more
like
than I do. I
yeah,
just think the potential's there for
yep.
those as well. So
No, I totally agree. It seems like a good mechanism for so-called smart contracts in the case of Ethereum, and other specific
yeah,
projects that Eric has talked about. That makes
yeah,
sense to me. The idea of it being, some kind of just generic new money to replace dollars or gold or whatever you like makes less sense right now, just because of the sheer utter volatility of it, and the fact that
agreed. Yeah,
I using it as a currency, it's like, to me it's just dollars, right? If somebody requires Bitcoin, or if for some reason that's the desired method of transacting, I'm just going from dollars to Bitcoin through the transaction, and back to back to dollars. You know, if I'm the
yeah,
receiver, I'm going right back to dollars immediately, because
right.
who knows? It could fall 20% the next day. You don't know. But it's an interesting thing. Well, I'll have to do more work on it so we can have a meaningful conversation. Um, but I feel like I know gold a lot better, and the fact that gold's making new highs, and has it been? People say, "Where's gold? Where's gold?" All through the sort of 2022, ride up to 9.1% on the CPI in June of 2022, near-term inflation peak for now. People are like, gold's not doing its job. Actually, I disagree. It has been fairly steady, and now it's making all new all-time highs. And
Yeah,
you don't want it to be like Bitcoin, right? You don't want it to be
right.
like quadrupling in a year or whatever it's been, or less. Um, so yeah, I like gold a lot for that reason still, and I like gold miners too for the reason we said. So there's lots of stuff to do out there right now, whether you're bullish or bearish or whatever. There's all kinds of stuff. And of course, we talked with Rick Rule, natural gas, dirt cheap, awesome. And he's waiting for nickel to get absolutely dirt cheap. Market is in total disarray. So there's plenty. I think there's plenty to do right now, and there's lots of good stuff to look out for. Um, so we know somebody who we're going to talk with right now who has a very unique and effective way of looking out for these ideas. It's a kind of a three-legged stool that he always reiterates his strategy every time we talk to him, and I'm glad because as I've said over the years, it's burned into my brain by him and Steve Sugarud. And this is our colleague Brett Eversole. He's the editor of True Wealth, which is a wonderful publication that's got lots of good ideas and as we'll find out today, an excellent trading strategy. So let's see what's on his mind and talk to Brett Eversole. Let's do it right now. The 2024 Stansberry Research Conference and Alliance meeting is back this fall in Las Vegas. And for the first time ever, they've extended their early bird discounted ticket pricing, which means if you reserve your seat today, you can save $450 off your ticket. Head over to www.vegasearlybird.com to find all the details and get your discounted ticket. The Stansberry Conference is truly one of the best business mixed with pleasure industry events out there. Past speakers have included Shark Tank's Kevin O'Leary, Dennis Miller, and Steve Forbes. And of course, all your favorite Stansberry editors will be there too, including yours truly. I mean, I hope I'm one of your favorites. I look forward to this event every year. It's great getting the chance to meet our listeners from the show, whether it's chatting during a break or grabbing a beer at the end of the day or whatever. So I hope you're planning to join us. It's a great event. Go to www.vegasearlybird.com to get your discounted ticket before prices increase. That's www.vegasearlybird.com. So come on out and find me in Vegas and say hello. Brett, welcome back to the show. It's good to see you again.
Well, thank you, Dan. Thank you, Corey. Appreciate you guys having me. It's good to be here.
Yeah. I really am curious to know right now, you're not going to believe this. Right now, I'm feeling like the market's kind of a one-way ticket till November, and or sometimes slightly before. You know how people look ahead or whatever, depending on who they think is going to be elected. But I want to know where you are on that one thought. You know, which way the S&P 500 and for how long?
Well, I'll tell you what, Dan, I was going to say positive things, but if you're going to lead with that, maybe I'm going to be a little more bearish in my thoughts.
Yeah.
I think
That's great.
I think in these election years, it's always kind of a toss up.
Mm-hmm.
There's obviously uncertainty with elections, and markets generally don't like uncertainty. And so what tends to happen a lot of times is you get a lot of volatility and chop through the year, and then you get a year-end rally once you get some certainty.
Mm-hmm.
I think we might get a little less of that this time around because we have two knowns running for president. The first time in modern history where we've had a current president rerunning and a past president running. So I think what either of these two would mean in a second term is a lot less scary for the typical investor.
Mm-hmm.
So we've had an incredible run in stocks for the last 3 or 4 months. I think it's pretty logical to assume that will at least slow down. But I don't see a lot out there to expect kind of a big downside between now and November. We'll probably get some chop along the way, get some good and get some bad. But if I had to bet, I would guess that stocks are higher come election day than they are right now.
Okay, so more tempered than what I said, but we wind up in the same place by election day, I think.
Yeah, there you go.
Yeah. So, are there individual sectors right now that are more attractive to you than others in the U.S. right now? Let's just stick with the U.S. right now.
Yeah. I mean, so to talk like kind of broadly, I do think stocks will do well through the rest of the year, and I think the market's in a pretty healthy place, and that's why I kind of have that opinion, even more so than an election coming up. I really like to look at like the fundamental underpinnings for the market. When I say fundamentals, I don't necessarily mean valuations, but more the kind of technical breadth of the market. This is something that I looked at last January that got me really excited and really bullish in 2023. And that was that for the first time since that 2022 bear market had started, most stocks were going up, not down. And throughout 2023, it was really driven by the Magnificent Seven and these massive tech stocks soaring. But the reality is, especially in the last few months, most stocks have been going up. You can see this a handful of ways. You can look at the equal weight index, which is instead of a market cap weighted S&P that you weight each stock individually. That is just a few percent away from hitting a new all-time high, and it's hitting multi-year highs right now. Similarly, the advanced decline line is something that I look at pretty frequently. This is just a cumulative index of how many stocks went up today minus how many stocks went down. You add that number to yesterday's total, and over time, it tends to track up and down with the market. Now, what you see in scary times is that you'll have stocks going up, the market going up, but the advanced decline line going down. And what that means is you are in a situation where only a handful of the biggest stocks are driving prices higher. Right now, the advanced decline line is hitting new all-time highs. So I think the general underpinnings are really, really good for the broad market. And that's why, again, I saw this happening last January, last February, and it made me incredibly bullish for 2023. Here we are a year later, or about a year later, and we have a similar situation. Now, having said all of that, I do think that there are certain areas of the market that are more attractive than others. The bigger stocks are very expensive right now. So I think if you go down in size a little bit, not necessarily individual names or individual sectors, but I think investing based on kind of market cap size right now is a pretty smart move. If you look at mid caps and small caps, they really haven't participated in the recent rally of the last, at least as aggressively in the last 12 months.
I was going to ask.
And you've got great valuations there.
Yep.
Yeah, so like the S&P 600, which is the small cap index, is at around a 14 PE. The mid cap index, the S&P 400, I believe, is a similar valuation, and that's compared to about a 22 on the S&P 500, the large caps. So you really do have not all-time great valuations in these smaller companies, but way better than what you're seeing in the broad market. So I think looking at those kind of areas, getting away from those Magnificent Seven names is a really attractive place to look right now.
Yeah, and in the mid caps, there's some great businesses and all up and down the market. But I know at least one investment manager whose name I can't think of, a Dutch guy. I don't know if he's still around. Who focused solely on the mid cap index, and I've seen several. I saw several presentations by him, maybe 3-4 years in a row, like a decade and a half ago or something. And I was shocked. I was like, oh wow, there's all these mid cap names that are really, really attractive, good businesses. So this is intriguing to me because I like
I think
good ones.
Yeah, I think that area size-wise is kind of the sweet spot in a lot of ways, because when you talk about very small cap companies, especially like Russell 2000 type companies, $1 to $2 billion companies, they're not necessarily at the size and scale to have the efficiencies of being a very large corporation. But they have all of the overhead and hassle of being a public company. Right. Whereas mid caps are kind of in that sweet spot where they're big enough for all that hassle and kind of corporate integration to make sense, but they're not yet big enough for most investors to know what is going on with them or to have a lot of coverage.
Right. And if you're looking, like it's like a great place to look for those that could, one day be a mega cap or something, because they've made it that far. Exactly what you're saying. Yep.
Yeah, that's kind of the hardest part in a lot of ways.
And Brett, are you kind of expecting the small caps to kind of play catch up to the rest of the market? Like, you talk about the Mag 7, and then even the equal weight indexes recently started making some new highs. So is it just a matter of the small caps catching up to the rest?
Yeah, I think there's kind of two things going on. Number one, I think, yes, that is the case. But the reason why, number two, is that we've had a lot of economic uncertainty in the last couple of years. The kind of will we, won't we recession that's been going on. I think in the past 6 to 12 months, in my view, as these much higher interest rates have kind of been absorbed into the economy, and we haven't gone into that recession. The jobs market is still incredibly strong. I think as every day that goes on, I think that major recession that people were worried about becomes less and less and less likely. And these smaller companies tend to be more U.S. focused, tend to be more more they rely on a strong, robust U.S. economy. And so investors haven't been willing to buy them and bid up valuations because of that fear of this looming recession. I think as we get farther from that and we get kind of into this more boring zone, we've had a wild few years of things going on, geopolitically, economically, a pandemic. There's been a lot going on. And I think we're probably going to enter into a more boring time. That's generally how these things work in bull markets. You have some crazy events, you come out of it, and then you have these boring years. And I think in that kind of environment over the next 2 to 3 years, potentially, people are going to start looking at these small caps and realize, okay, the U.S. economy isn't collapsing. These companies are incredibly cheap, and they have great prospects because the economy is kind of turning over and getting better. And I think that can be a catalyst. The question is, what you have to realize is you're making a bet not for today or tomorrow or next month or even this year, but that's really like a 3 to 5 year bet, that you could see that kind of catch up and outperformance versus large caps. But there'll be a lot of volatility along the way. And of course, if that strong economic underpinning turns around, that's not going to work out at all.
Yeah, that's kind of what I was thinking the other day. Like, we've had so much kind of, it feels like chaos, the last couple of years. And I feel like there's like a lot of market PTSD still from 2020 and expecting bad things to keep happening, but yet the market keeps going higher generally. So it's, at what point does that fear fade away? I guess at that point, maybe we're in the euphoria end of things, right? Like the way these cycles go.
Well, I think that you strike into a really important point. And if you look back through history, like this is how things play out. From in 2007, 2008, we had the great financial crisis. We came out of that. The market delivered really strong returns in 2009, 2010, but then we ran into this European debt crisis. And everyone was wondering in 2010 and 2011 if the US was going to have a double dip recession. So we had this 3 or 4 year period where it was insanity. Nobody had any stability or any certainty about anything. And then 2012 through 2016, 2017 or so, it was pretty boring. Like not a lot happened economically. We realized we were past the craziness. The economy grew, companies grew earnings, valuations increased, stocks prices soared. But there's not a lot you can point to in that period that was exciting. You look back in history farther and you find the same thing. In the early 80s, you had the double dip recession, the crazy inflation, Volcker's 20% interest rates. But by 1983, 1984, we were mostly past this. And then you had 6 or 7 years before 1987 where the markets kind of boringly marched higher. And it was the same thing in the early 1990s. You had the Gulf War in 1991, a recession in the US economy, a bear market. And then you had 92, 3, 4, 5, where stocks just kind of steadily marched higher before you got to that euphoria point. So I think that we are early stages of a major bull market. I think it began in the bottom in 2022. I think we are a couple of years into it now, and we're getting through all of the craziness that allowed it to begin. And now we're going to enter those boring years, 2, 3, 4 years, where hopefully, fingers crossed, hopefully not a lot happens. Earnings grow, prices move higher. It's kind of that healthy, uninteresting stage. But this is where you make a lot of money as an investor, is sitting tight and doing nothing in those boring times.
From your lips to God's ears, boring would be very welcome to me.
Yeah.
Actually,
boring is beautiful.
Boring is beautiful. Right, it really is. Boring is like compounding. When you start talking to people about compounding, they start kind of dozing off. You can see them, and when you're on stage at a conference and you're talking about compounding, their heads are bobbing in the front row, and the second and the third and the last. But that boring stuff, man, that's where the big money is made, right? Boring compounding over many years.
Yeah.
I hope you're right.
Yeah. Yeah. I maybe I'm just talking about what I want to have happen, but it's what I think will happen too. But yeah, I mean, you're 100% right, Dan. And I know you have that deep value investing tilt that I don't necessarily have, which makes you even more attuned to that idea of that long-term compounding, because you find that good company that can grow over an extended period of time. And if you do that and you buy at the right price, what happens in between is kind of irrelevant, because 5, 6, 7 years down the road, you're going to do incredibly well. And it's just finding the right company, paying the right price,
and then doing nothing, which is really, really hard for a lot of people. For human beings, I would say generally, doing nothing is really, really hard.
Yeah.
So let's see. Did I miss the part where we talked about sectors you like?
Oh, yeah, I didn't
Okay.
necessarily do that.
No, I don't think we
No,
missed
we were
that.
talking
Yeah,
about cap, like mid cap, but I was talking
yeah,
about, like home building or
mid cap,
whatever,
small cap.
just
Yeah,
whatever industry you like.
So I'll evade your question again, but I'll give you a more specific answer when evading it. So one of the ETFs that I recommended a few months ago is the Cambria Shareholder
Oh yeah.
Yield Fund. So what this does, the ticker SYLD, and this is from our friend Meb Faber, who runs
Yeah.
Cambria. He's a great guy, does great analysis, and builds these really cool ETFs based on his analysis. So shareholder yield it's a combination of buybacks, dividend yield, and debt pay down. This is just all the cash you can return to shareholders
Mm-hmm.
in various ways. And it turns out that if you buy companies that return tons and tons of cash to shareholders, those companies tend to go up a lot over time. There's a book that we kind of call the Bible in our office. It's Patrick or James O'Shaughnessy's "What Works on Wall Street," and this is very much a finance nerd book where he just tested from 1928 onwards hundreds of strategies and then combine various strategies together to get thousands of permutations of kind of what works. Uh, what could have led to the best returns over the last 100 years or so in the markets? And one of the absolute best strategies is buying companies with the highest shareholder yield when they're moving up. So momentum plus shareholder yield. I think from 1928 to
Mm-hmm.
2009, that strategy turned $10,000 into 1.8 billion, which is something to the turn of 25% a year.
That's pretty awesome.
So this stuff really works. What's interesting about that strategy right now is Meb looks at the entire universe of stocks, but what it ends up buying right now are generally mid cap and smaller large cap, generally 2 or maybe 5 to 15 billion market cap stocks. So this is kind of falling into that. It's got lots of energy and financials in there right now, which at a glance you would say that doesn't make a lot of sense. But at the same time, these are the places that nobody has any interest in owning. That's why you're getting this great value. And the fund in total doesn't pay it out as a dividend, but the cumulative shareholder yield of its holdings are somewhere in the 12 to 14% range, which is kind of crazy when the S&P pays a 2% dividend yield. Maybe buybacks get it to 3.5 or 4. So again, I'm not answering your question on a sector basis, but I think looking at the right kinds of companies based on size and based on more of those immutable characteristics, if you will, like companies that treat shareholders well, I think those are the places you can go to take advantage of that right now. And so, yeah, shareholder yield, again, these stocks are really cheap as well. I think they trade for like an 8 PE, 9 times free cash flow, something like that on the fund, which is, maybe 60 or 70% less than the S&P 500. So there's a lot of value there and a lot of opportunity, I think, over the long term.
All right. But yeah, strategy is as good as an industry. I mean, whatever you like, I want to hear it. So that's great. And I know Meb and
Yeah.
love his work.
And Brett, just about like when we're talking strategy, like the strategy that you guys with True Wealth, I guess and the systems. Can you explain a little bit about that and how that might mitigate some of this worrying that a lot of people constantly have in the markets in general, just as far as like it's very hard for people to do nothing. Like everybody feels like they need to be doing something all the time. But I know from just reading your guys' work that a lot of what you do kind of eliminates that.
Yeah, very much so. So, like the strategy that I use is the strategy that I got from, my past boss and definitely mentor, Steve Sugaroon, who launched True Wealth back in 2001, and that is you buy stocks that are cheap, that are hated, and that are in an uptrend. And this is a very simple concept. I think that almost any even novice investor can get a handle on. You want to buy companies at good valuations. You don't want to overpay. You want to look for things generally that most other investors are not excited about. You don't want to buy AI stocks right now. You don't want to buy NFTs in 2021. You want to look for things that people are not clamoring to overpay for. And then you want to buy those things when prices are moving up. I think, Dan and I probably would agree when it comes to deep value investing that the cheap and hated part is generally the value investor's Bible to a certain extent. But to me, the most important thing of that is the momentum, is that trend, because you can just have a lot of things that are great value and that are hated by investors. But if the price is still going down, you're still taking a lot of risk. So the most important thing of our strategy is using simple momentum to understand when we can take advantage of these opportunities. Because a lot of times you'll have things that are cheap and hated for a long, long time. And you can get just punched in the face over and over and over again, waiting for prices to reverse.
Sometimes they can
or you can
keep getting more hated, right? Yeah.
Exactly. Yeah. They can get more hated. They can get cheaper. But if you just kind of wait for prices to reverse, that's the market telling you what you were onto is finally right. Because at the end of the day, if you buy something and it takes 5 years for it to start going up, you weren't early, you were wrong. And so it's easier to just wait for prices to kind of give you that buy signal. So again, we look for things that are cheap, we look for things that are hated, but we wait for prices to tell us that it's safe to buy right now. And then kind of on the back end of that, we just use trailing stops for everything. We have fixed stops. Most investors, I think especially novice investors, they only think about the buy. The buy is the sacred cow. It's the most important thing to figure out. But if you don't have a plan to sell, or why you'll sell, what will make you change your mind, what will be the thing that says, I haven't changed my mind, but I'm going to sell anyways. If you don't have that in place beforehand, it's really hard to figure it out in real time, because emotions are they can be all encompassing when things are not working out like you expected that they would. So generally speaking, we use trailing stops on everything. And that's the simple way to say, I don't agree with the market right now, but it doesn't matter. I'm going to be diligent and I'm going to sell. So again, we have our strategy for buying, but then we also have a strategy to sell. And that's what really protects yourself from those catastrophic losses that can absolutely crush a portfolio.
Yeah. And that fits with a lot of, Dan, what we've heard from even different kinds of traders, having that plan to know predetermined when you're going to get out, and your goal, and then you're managing the risk reward. So many people just never get to that point, and they just get in and get burned. I'm talking about like you first time investor. You get in, you're like, there's no way I can figure this out. But it's really the risk management is, I don't think can be said enough.
And
so,
in our business, we have
a
a unique sort of perspective, don't we? Because if we don't use like trailing stops and we say, well, I want that 25% a year thing that Brett's talking about, and if we try to go after that, you will see a massive draw. You will see multiple massive drawdowns during that period. It is absolutely going to happen. 40, 50%, maybe more. And people hate that. They think you're an idiot for walking them into it, even if the strategy is to, hold for 3 decades and compound it at an ungodly high rate and just get rich by doing nothing. And also, the thing that causes people to think we're idiots is the thing that loses them a ton of money. Because at the moment they think we're idiots, they're selling everything at catastrophic losses that Brett is talking about avoiding. So we really have an extra good view on this phenomenon. And we've come up, I think, the use of trailing stops throughout most of our portfolios, if not all of them just about, is, I think, an excellent way for us to just sort of show people that you can get better control of this. You don't have to sell out down 60, 70% in a panic and abandon stocks for the rest of your life. You can stay in the market in a reasonable, doable way that will still allow you to get a lot of that compounding done over time. It's the bad thing. The thing that Peter Lynch said is the mistake people make with stocks is getting scared out of them. And you get scared out of them by living through one of those catastrophic losses, right? And we avoid that. We're very good, in fact, at avoiding that. People don't write in and say, you blew me the hell up, because we just don't do it for the reasons that Brett is talking about. So this is
Well, and there definitely is. I mean, you probably know this, Dan, that there's some disagreement among some of our analysts as to whether trailing stops are the right thing to do or the wrong thing to do. And I understand the other side of that argument, because a lot of times when you plug things in a spreadsheet, you can come up with better overall returns or better risk-adjusted returns by having some
Yep.
a less explicit strategy. However, I think it's very easy in the world of finance, the world of personal finance, the world
Yep.
of anything money related, to think the spreadsheet is the best option.
No.
But we don't live in spreadsheets, and it's very, very hard.
Humans aren't
Spreadsheets
computers.
don't have
That's right.
emotion.
Yep.
Is the problem, and so yeah. So once you take that idea out of the spreadsheet and then you have to actually execute it, unless you're this emotionless drone that can go through the world doing that, it's really, really hard not to make those major, major, major mistakes. Because I'm sure you know stories about this kind of thing happening where somebody really believes in a company. They don't sell down 25% like they should have. They see it down 50, and that's the exact moment they shouldn't be selling, because all of that opportunity they saw is
Yep.
about to
It's
take
there.
place. It's about to go up 3
Yep.
or 4 or 5x over the next 7 years.
Yep.
But they can't make it through that down 50. And they can't ever buy back in because they've been burned
Right.
and have so much pain associated with this now. And it just happens over and over and over again. And in my view, if you want to try to fight that war, you can. I don't recommend it. I think the better thing is to have a strategy
you're not
to
Warren
avoid
Buffett, simply put. That guy, he bought,
Yeah.
he's bought
Yeah.
these things and held them for decades and decades, some of them. And of course, they've compounded at wonderful rates. But he's, he wrote a thing in his latest shareholder letter about how, the difference between earnings and, I guess it was like operating earnings. And, earnings takes out the losses, the mark-to-market losses, and the operating earnings didn't do that. And those are the ones he wants you to see, because that represents the real performance of the business. And the other thing is just stock market quotations that he's not selling, usually. So, this is a big topic.
Well, he's also, he's not getting a bid on any of those businesses at any point in time too. It's like I think it was either he or Munger that said that story about, if a crazy guy walks up and throws prices at your house every day, right, you don't have to take one. But that's kind of like what the stock market is. And it's funny because, historically people talk about a liquidity premium that happens in the stock market. And I think in Buffett's case, he's almost getting a premium for illiquidity. He buys these businesses outright and holds them forever. And he could go out and market them and sell them. But I think that there's actually value added in not having the ability to sell in a lot of cases. If you can buy really, really quality things, I think there's an illiquidity premium that comes with that. It takes time for it to show up. But I think that really has been his secret.
You're not the only investor I know who's been around the block for a number of years who's arrived at that conclusion. It's true, and
we could all be so lucky
when you add
to be
the imprimatur of Buffett to
have that
the
problem.
Equation. It amplifies the point, but that's not even necessarily required for that illiquidity premium to exist. And I agree. It's an interesting phenomenon.
Yeah, I mean, so one thing for me personally, I put a lot of my personal money into private real estate deals in the last few years, and I don't get quotes on those whatsoever, and I know they're probably not going to cash out and pay out for the next 2 to 3 years. I've had an incredible benefit because of the fact that I haven't seen what those things are worth on a day-to-day basis. A lot of these are construction type phase projects, but it's been a rough period in commercial real estate, and valuations have come down a lot in a lot of cases. But I know for a thing I invested in 2022, I'm not going to get a payout until 2025 or 2026. And so we've had this rough period for that market. I haven't had to see it or feel it or experience it. And if it didn't exist at all, my payout in 2 years probably would be a little higher than what it will end up being because we've had this rough period. But I've had no emotional toll associated with that whatsoever, which I do. I think that there's a premium to illiquidity, and it's not necessarily all returns. It's also kind of the emotional havoc that massive volatility can.
And you can see there's a broader point to be made here. There's a brilliant analogy to be made just in the form of the how shall I say, the Amazon river of information that comes at you over the internet every day. It's anxiety producing, right? And you get that same thing with endless stock market quotations and, after hours and overnight and all that, it's just endless. It's an endless bombardment that you are not getting from your real estate deals. So you're sleeping a lot better than the average person who doesn't quite, know how to respond to all this stock market oriented news and other types of news that tend to move things around in the market. Um, this is, we're sitting here having a conversation about human nature, which I think is entirely appropriate. And a lot of that psychological stuff,
Yeah.
um, it can get too much, but you can't ignore you just can't ignore the element of human nature in when people are investing in the stock market. It's just, at this point in our careers, like I've been at it with Porter since what, 2000 or so, and we've seen, multiple cycles up and down in not just stocks but in commodities and gold and various things. And it's just amazing how human beings never stop being human. I mean, they just can't help themselves. And there was that book, I remember there was that book that came out by Dan Ariely called Predictably Irrational. And some brilliant guy made a joke. He says, I'm going to read this book, but I'm going to read it so that I'm not predictably irrational. And that's an excellent point. You can't help it. You can know all about it and you're still predictably irrational. It's just, you can't stop being human when you're human. It's a very good point.
Well, I think the point that you take away from
Right.
that, what do you
What
do
do
with
you
that?
do?
Because like you say, this is inescapable. So what do you do? And I think like a trailing stop is a perfect example of what you do. You set up simple guardrails to protect you from yourself, because a future you is going to want to do some really boneheaded stuff. And if you set up some guardrails right now, you can stop that future idiot from doing those things. And it's not going to work every time. It's not going to be perfect. But I think if you don't have that figured out, the rest of it is almost, maybe not entirely, but almost irrelevant, because you can be the best stock picker in the world. But if you don't buy at the right time and have a plan to sell if things go wrong and understand how to understand how you can be wrong.
Yeah. Future you is
nothing
going
else
to
really
be
is important.
changing his underwear at a rapid pace if you don't understand that stuff, before you need to. Yeah. So now that we've covered, the hopelessness of future you if you don't know what you're doing, um, and and liking mid caps and liking, the shareholder yield strategy. Um, let's and your overall idea, which is a very familiar one to us here at Stansberry Research, of the cheap, hated, and in an uptrend. Um, what do you make of a market? And I'm just not quite picking at random, but almost at random. What do you make of a market like China? If I look at a China ETF right now, I just see a big decline that doesn't appear to be stopping. I don't see that. I see, hated and cheap. When I look at the headline PE on a China ETF, like 9 times or something, and there's definitely hated. I mean, it's down, down, down. There's a lot of negative narrative around China. Um, are you just, in that case, you're just kind of waiting for things to tick up, or maybe you don't agree that China's the one that's hated and cheap enough, but how do you look at a market like that right now, if indeed you are?
Yeah. So, I mean, sure. Now it's funny. I actually have a great answer to that and a way to take advantage of it, even though I don't think it's a great buy right now. I've covered Chinese stocks for around a decade now. I visited the country the first time in 2013, and we've had a China letter over the years, and I spent a lot of time thinking about Chinese stocks. What's interesting is that when I went to China the first time in 2013, I thought the market was hated then. And then in 2014, it was a little more hated. In 2015, a little more hated. And it's just gotten worse and worse and worse. And that really has gone into like a fever pitch in the last few years. Between the trade war with Trump in office and then this massive regulation regime that the Chinese government put in place circa 2021, 2022. And we've seen these major Chinese stocks fall, 60, 70, 80, 90% in some cases. And they are incredibly cheap. So a company like Alibaba, which is the Amazon of China, a massive e-commerce business, traded for 30 to 40 times earnings 3 years ago, trades for around 10 times earnings today. Tencent, a massive gaming company, again, traded for 30 to 40 times earnings a few years ago, trades for around 12 times earnings today. These stocks are going to grow double digits every year, top line, for the next few years. Their growth phase is not over, but they've gotten incredibly, kind of painfully cheap. But because of this massive regulation campaign, foreign investors have mostly fled from that market. China is the least invested, or least owned by foreign investors at any point in the last decade. Normally, I would look at this market and I would say, it's definitely cheap, it's definitely hated, but you really have to wait for the trend before you can even consider buying, because a market like this can just become a value trap for years and years and years. I honestly would not be surprised if Chinese markets are trading at similar prices today, or similar prices to today's in 2 or 3 years' time. And that's why you really want to wait for the trend before buying, because you can just end up with this period of dead money. I also wouldn't be surprised if they fall by 15 or 20% more, even though they're down 60, 70%. One way you can take advantage of that, which is a very unique strategy, is an ETF from our friends at Crane Shares. It is a covered call strategy on their China Internet ETF. So this is the China Internet ETF is ticker KWEB, KWEB, and it is just Chinese tech, if you will, very simply. So they have another fund, ticker KLIP, which sells covered calls against KWEB. So normally, I talked about this at the conference last fall. Yep. So normally a covered call strategy, you buy the stock, you sell a covered call, you collect, somewhere in the realm of 10 to 12% a year is what the typical volatility on the S&P 500 would produce. Chinese tech stocks are much, much more volatile than US stocks. So that 12% or so actually is in the 40% range. It'll vary dependingly, but Clip is paying out roughly 40 to 45% in dividends. Now, that dividend is not guaranteed. It pays out monthly. If prices go down, that dividend is going to go down. If volatility goes down, that dividend is going to go down. But that is an absolutely incredible, number one, safeguard if prices go lower. And then also, even if prices go nowhere for 2 to 3 years, that yield is probably going to be in the 30 to 35% range consistently. So Chinese stocks could be flat for 3 years and you could make 100% on Clip. Amazing. Now, I knew about this fund. Yeah, I knew about this fund when it launched, but I kind of wanted to see what it did in the wild before I thought about recommending it. So it launched in January of 2023. It's up 7% since then. And the underlying index, KWEB, is down 26%. So it really, this has been a brutal year for Chinese stocks since it launched, 14 months. And it's absolutely done its job. Not only has it saved you from those losses, but it's actually led to a positive return. So in most cases, I would say you should avoid Chinese stocks because the trend is not there and I don't know when it's going to show up. In this case, you have a unique way to kind of get paid to wait and potentially make big returns, even if prices go somewhat lower from here. So that kind of answers your question in 2 ways. But yeah, I think Clip is a really, really cool idea. And it is kind of a safer way to get exposure to that. Because I think long-term, China's the second largest economy. It'll soon be the largest economy. It seems unlikely to me that its stock market isn't dramatically larger 10 years from now.
I'm looking at a Bloomberg chart of Clip. And it seems to have started trading in 2023 around 24, 25 bucks. And it says it's 14 today and it's like down and to the right.
Yep. It is. And so if you can do a total return chart with all those massive dividends pumped into it.
Nice.
Yep. So that's the thing. You've got to buy this. And if you don't account for those dividends, then it just goes down and down and down. And that makes sense because the underlying index is going down, right? But here's what's interesting about Clip to me. Let's say instead of going down, Chinese stocks go up 50% over the next year, which is entirely possible in a market like this. We've seen Clip's dividend fall by about half over the last year. That's because volatility has gone down a little bit and the price has gone down. But if the price of KWEB goes up, volatility stays similar, those dividends are going to grow.
Right.
So today's 40% yield could be 60% in next year's money. So we've had this kind of vicious cycle. It could turn into a virtuous cycle.
The dividends since March of 2023 are basically 65% of the current share price. So anything like that performance for another year and a half or so, or, year or two, and you're good. It's gravy from there. Very interesting.
Yep. Yeah. Yeah,
Right.
it's not like this can't lose money, but even in a choppy down market like the last 12 months, it did pretty darn well. So to me, that's a good sign.
That's really cool. That's very, very interesting to me. And of course, you did talk about this before, but I totally forgot about its existence. And it's just really,
Yeah.
really cool looking.
Yeah.
It's a good idea. And it's sort of, these covered call strategies have been around for, it's nothing new, right? But to do it right on this sector in this country around this time is the kind of stroke of genius moment there. That's really cool. All right. All right.
Yeah.
So
Yeah. That's
mid
what I think.
caps, all kinds of good ideas. See, this is why we like having you around. We got tickers, we got, mid caps, we got a couple of tickers, we got, clip, we got, what's the shareholder yield, Mebs? SYLD.
SYLD.
So we got SYLD and KLIP.
That's it.
I mean, you got anything else? You're overflowing with ideas here. I don't want to stop you.
I can't give you the whole portfolio today, Dan. We've got a few, but I can't get people. True wealth readers are going to be upset if I give it all away. So,
well, let's see. We have been at this a little while here. Why don't we head to our final question and see what you can come up with for us? It's you've answered it, of course, before. I hope you don't remember it because that helps it work better. But it's fine if you do. Good, excellent.
I don't remember it. I was racking my brain. What was the final question Dan asked me?
Excellent.
But I forgot.
It works
what it was,
better. So the final question is the same for every guest, no matter what the topic, even if it's a non-financial topic. And if you have already said the answer, feel free to repeat it and take your time because we can edit. And the final question is, if you could leave our listeners with a single thought today, a single idea, what might that be?
I think to our conversation about behavior problems in investing, I think that broadens even out more to life. The idea of setting up guardrails for yourself. There's this, thought of entropy in the universe, and I think that applies to the individual as well. And it's really easy to kind of allow yourself to go down paths that you don't mean to go down because you don't have proper guardrails in your life. That is very clear and apparent in investing, but I think it happens throughout life. I had personally been in, I would say, relatively not great health shape 3 or 4 months ago. And it's because I hadn't had guardrails in my life. And I made not major, 2 or 3 small changes to how I go about my day-to-day life. And it's been a dramatic improvement in my overall health, wellness, and how I feel. And so I think it's really important to set up those simple guardrails in your life. And that's going to be different for each individual. But if you don't do that, it's so easy to just wake up 6 months down the road or 12 months and be like, how did I get here? What is going on? Because generally speaking, it's small little things that compound again over months, weeks or months or years that turn into big problems. And so I think if you evaluate your life every 6 or 12 months and say, what guardrails do I need to put in place? You can dramatically improve your life. You can improve your investing by doing that in those ways. But I think you can that expands entirely to almost every part of your life. So that's something that I try to do is reevaluate myself, figure out what I can do to improve. And the crazy thing is those changes are generally pretty small and pretty simple. But you just put them into place one day at a time, and you wake up 6 months later and you'd be like, how did I get here? Because things are
beautiful.
So much better.
Excellent answer. And I totally agree. Like little things. I stopped drinking soda and orange juice every day. And I went from like 205 to 172 in a matter of several months. It was like, whoa, it was dramatic. I mean, really. So I hear you. I believe you.
Yeah, that's one of my rules.
Yeah.
One of my rules is don't drink calories, which sounds, it's a simple thing. But you just
all right, Brett. It's always a pleasure to talk to you, man. And I'm glad you.
I am loving the cheapest beer now.
That's right.
Versus IPA. No more IPAs for me.
There you go.
Cheap beer as well.
I knew you guys were thinking beer. I knew beer was on everyone's mind when he said drinking calories. It had to be, So I'm glad you gave voice to that, Corey. I appreciate it. Yeah.
Well, that's just me. I'm not going to
I
speak
mean,
for
yeah.
Brett. That's me. Yeah.
All right. Anyway, look, thanks a lot, man. I'm sure we'll be talking to you soon, and it's always a pleasure. The Fed wants you to believe they've got inflation under control, but I believe we've only seen the beginning of a devastating new crisis. And if you don't prepare now, you could see your savings evaporate as inflation and interest rates soar even higher over the next 2 years. It all traces back to a golden thread that ties together the biggest financial calamities in America's history. But it seems the entire financial world is falling into this very same denial trap that led to massive devastation the last time this crisis played out. If you know your history, you know there will be winners and losers, and now is when you decide which one you'll be. I've spelled it all out in an urgent new report. Go to www.bankrun2024.com to get your free copy. I'll also show you how to get my complete playbook for navigating this crisis, including the 3 critical steps to take immediately. Again, that's www.bankrun2024.com for your free copy of my new report. Always a pleasure to talk to our friend Brett Eversole. I was just thinking how long it's been. I don't know. I forget when Steve Sugarud brought Brett into the company. He's been around for a long time though. And
Yep.
when I met him, he was a pretty young guy, and he's still young, but a lot more experienced. And it was just a real pleasure to sit here and see this guy who I've known for all of these years, who has matured into this um, really thoughtful guy with lots of very good ideas, penetrating analysis. He knows who he is as an investor. And of course, like I said, ticker symbols, man. You know, Brett's got ideas for us. Buy mid caps, buy the SYLD, buy KLIP. It's just a real pleasure to have a guy like him on the show.
Yeah, he's as you say, he's mentored by Steve
Mm-hmm.
Sugarud, and yeah, that was probably at least 10 years ago when he got brought on. And yeah, just kind of picked up where he left off in True Wealth, and that's the great thing about like the system that Steve and Brett and the whole team with True Wealth has developed. Like you can apply it to all of these different
Mm-hmm.
areas. So like
Yeah.
that's why a guy like him is able to give off all those tickers on China and shareholder yield and whatever else. I mean, I remember back in you remember when oil went negative in
2020. Yeah.
2020?
I tried to buy it.
Um,
They wouldn't let me do it.
Of course you
They
did.
wouldn't let me do
Of
it.
course you did. Yeah. Well, that my point is there that eventually, when the trend started going back higher and energy was still cheap and hated, I remember them recommending energy well before anybody else was, and when it was, a lot of money to be made in it, and it was, still but waiting for the bottom to
Mm-hmm.
occur
Yeah.
first, and not trying to catch it at the exact bottom. You don't need to
No.
like catch exact bottoms or tops.
You
for
can't
that matter.
hope to. That's
If
right.
you get the middle right, if you get the middle a lot of times, you're in good shape.
Yeah.
So,
Yep.
yeah. So anyway, I'm glad he gave some insight into just how they go about finding stocks, which I think anybody who was listening and watching could pick up on.
Yeah. I mean, thanks to those guys, Steve and now Brett, the phrase cheap, hated, and in an uptrend is just like burned into my brain
Yep.
for all eternity. I'll never forget it. Every time I look at something, even if I don't have those exact words in mind, certainly cheap and hated are very important to a value guy. And because I've been around Steve and Brett so much for so many years, decades now, the uptrend part, even though I'm not a momentum guy, I don't usually worry about that. The uptrend part, it's just that voice is in my head, so I can't help thinking about it. And every now and then, man, we do find one of those, and those are some of our best performers in extreme value, the ones when we catch them just right, and boy, they take off and they don't look back. It's a beautiful thing. Wow. Okay. That was a great interview. I hope it's as good for you all out there in listener land as it is for us. to just have a thoughtful conversation with our friend and colleague, and get a lot of good ideas. I mean, I'm writing the ticker symbols down. I hope you are too. But yeah, that's another interview, and that's another episode of the Stansberry Investor Hour. I hope you enjoyed it as much as we really, truly did.
Opinions expressed on this program are solely those of the contributor and do not necessarily reflect the opinions of Stansberry Research, its parent company, or affiliates.